throw out a name that you're recommending to investors right now, whether it's something that's on your own mind or something that you've been doing research on. So, Chris, why don't you go first for us?
Sure. Planet Labs is a new security that's going to be trading tomorrow for the first time, ticker PL. It is getting de-SPACed from an existing SPAC, ticker DMYQ. I'm long it, or will be long it tomorrow when it starts trading. I think it's just a spectacular, important company. Subscription miniature satellites that have daily imaging, highly detailed imaging of the whole globe. That's going to be extremely useful, I know, to hedge funds such as mine, insurance, a myriad of other industries. I think it's extremely valuable based on some of the kind of trading attributes of how SPACs tend to work. It's fairly close to its trust value right now. I think it's worth a multiple of that. I think this is the kind of thing that could easily double or triple in public markets in the days ahead and months ahead. So Planet Labs, ticker PL, I'm long and glad that I am.
PL, copy that. Brad.
Yeah, so I just went to our screening tool at iReal Alpha, and we've got a number of strong buys here. I'm going to go with one of the higher risk names, and this has had a lot of conversation on Seeking Alpha, so it's probably no surprise. I'm going to say Omega Healthcare Investors, that's ticker OHI. Now, again, this skilled nursing sector, and I alluded to this earlier here on your show. It's a higher risk, certainly more volatile sector, probably the most volatile sector in the healthcare industry. But we actually published a note last night on our marketplace service. CareTrust was actually reported yesterday. Bloomberg reported potential discussions for potentially the company being sold. There's going to be potentially some private bidders out there for sure, but I think Omega, of all of the healthcare REITs, we think Omega Healthcare OHI is probably the most logical buyer of the in the publicly listed REIT space. Now, of course, M&A should never be a catalyst. We think there are plenty of other catalysts. And the primary one, again, going back to that macro conversation, is just that silver tsunami, that aging population that we're seeing out there that's going to catch up. And occupancies are continuing to normalize in skilled nursing. This company is trading at a pretty substantial discount, no matter whatever multiple you want to look at. The dividend yield right now, which is probably the most retail investors look at the dividend yield, which is about 9.1%. The company has covered its dividend in the third quarter. The question is, will these operators be able to hang on? The question is, will the government still continue to provide support to these skilled nursing operators? A lot of questions, a lot of risk, but we think Omega Healthcare Investors is definitely a strong buy, and we're going to maintain that.
All right, and the king of macro himself, Eric.
Yeah, and thank you, Brad, for some of those earlier comments. And I promise we're not just backslapping each other here, but I talked about sectors that do well when growth is accelerating and growth is decelerating. And I get asked about REITs all the time. And REITs is one sector that I usually punt on because it's such a broad and diversified sector that there are some really cyclical REITs that get absolutely hammered when growth is slowing. And then there are some REITs that do really, really well when growth is slowing, or vice versa. So REITs is a sector that you definitely need to consult someone that can dig into the fundamentals in the specific company. Whereas something like financials, XLF or KRE, regional banks, I could say pretty cut and dry. When growth is increasing, financials do really well. When growth is decreasing, financials do horrible. It's not so black and white with REITs. So that's one thing to keep in mind. As far as I'm concerned, whenever growth is slowing, you want to be long the longest duration that you can find. For me in the macro space, that would be the longest duration treasury bonds that you can find. Depending on your risk tolerance, these are treasury bonds, but doesn't mean they're not, they don't have volatility and risk. Like if you go out there to a ticker like ZROZ, you get almost a 25, 26 year duration. And since March, this inflection in growth, it's only about 9 months, but ZROZ is up almost 27%. And that's a treasury bond. A little bit low, 25-year duration would be EDV, and TLT is probably the most common one, about an 18-year duration. But as long as growth continues to slow, which my work says that it will, you want to be long, the longest duration that you can find. And I'm coming out with my monthly cyclical report, and investors that will get a full chart book of all the cyclical trends that come along with that too. So for me, as long as growth's slowing, you want to be long the longest duration that you can find.
Fantastic. And thank you again for joining us, everyone. This has been Chris DeMuth Jr. from Sifting the World, Brad Thomas from iRead on Alpha, and Eric Basmachin from EPB Macro Research. All of their services are found on Seeking Alpha Marketplace, so make sure you check it out, and we'll see you in the next program.